Hi, today we are going to talk about the credit crisis of 2007 to 2008. The credit crisis of 2007 to 2008 began with a crisis in the subprime mortgage market in the United States in 2007, and then developed into a full-blown international banking crisis. During the year 2007, IndyMac failed on July 11th. Fannie Mae and Freddie Mac were taken over by the federal government on September 7th. And on September 15th, Lehman Brothers went into bankrupt. Goldman Sachs and Morgan Stanley converted themselves from investment banks to bank holding companies on September 21st. And on December 16th, the federal fund rate was lowered to 0%. A natural starting point for a discussion of this credit crisis is the United States housing market. But before we talk into details about the U.S. housing market, let's have a look at the demand and supply curve. In macroeconomics, supply and demand is an economic model of price determination in the market. As shown in Graph 1, if the quantity of the demand of the commodity goes up, the demand curve will shift upward, and the price of that commodity will increase. Similarly, if the demand goes down, the price will decrease. And on the contrary, as shown in Graph 3, if the quantity of the supply of the commodity goes up, the supply curve will shift downward, and the price of that commodity will decrease. Similarly, if the supply goes down, the price will increase. Now, let's go back to the U.S. housing market. From the figure, we can see that the real estate price started to increase drastically since around 2000. So, what happened? From 2000 to 2003, in order to soften the effects of the collapse of the dot-com bubble and the 9/11 terrorist attacks, as well as to combat a perceived risk of deflation, the Federal Reserve lowered the federal funds rate target from 6.5% to 1.0%. Lower interest rates encouraged borrowing. This led to an increase in the national purchasing power. And on the other hand, at the beginning of 21st century, during a period of tough competition between mortgage lenders for revenue and market share, and when the supply of credit-worthy borrowers was limited, mortgage lenders relaxed underwriting standards and originated riskier mortgages to less credit-worthy borrowers. This also caused a dramatic increase in the national purchasing power. Very low level of interest rates and relaxed mortgage lending practices together increased the demand for house, causing house price increase faster. So, is this higher house price a good thing for mortgage lenders? Before I answer to this question, I need to explain a word foreclosure first. Foreclosure is a legal process in which a lender attempts to recover the balance of a loan from a borrower who has stopped making payments to the lender by forcing the sale of the asset used as a collateral for the loan. In short, it means that if the borrower of mortgage stops making payments, the lender will take over the ownership of the house and then try to sell it in the market. Now, let's back to our question. The answer is yes. Because a higher price means that the value of the house is more than the value of the mortgage balance. If the borrower defaults, the resulting foreclosure will lead to little or even no loss. so the lending is well covered. However, the mortgage lenders want to make bigger profits. In order to achieve that, they need to guarantee more mortgages. But the higher house price made it more difficult for people to buy a house. So the mortgage lenders relaxed their lending practices even more, so that the more people can buy the house. And how did they do that? For example, in early 2000, a subprime borrower had a FICO score of 660 or less. By 2005, many lenders dropped their required FICO score to 620, making it much easier to qualify for prime loans and making subprime lending a riskier business. Loans moved from full documentation to low documentation and then to no documentation. One subprime mortgage product that gained wide acceptance was the no income, no job, no asset verification required mortgage, as known as NINJA. These loans were aptly referred to as liar loans because they encouraged borrowers to be less than honest in the loan application process. Now, it's reasonable to ask a question. Why didn't the government regulate these activities of banks? First, easy availability of credit in the U.S., fueled by large inflows of foreign funds after the Russian debt crisis and Asian financial crisis of the 1997 to 1998 period, led to a housing construction boom. So actually, the government tried to expand house ownership by applying pressure to mortgage lenders to increase loans to low and moderate income households. Some state legislators wanted to curtail this predatory lending but failed eventually. Furthermore, some research shows that the bank regulation based on the Basel Accords encouraged unconventional business practices and contributed to or even reinforced the financial crisis. Subprime did not become magically less risky. The Wall Street just accepted this higher risk. And these people were unlikely smart and creative. They used complex financial instruments such as off-balance sheet securitization and derivatives, so that their activities and risks became very difficult to monitor. In result, the U.S. households and financial institutions became increasingly indebted and over-leveraged during the years preceding the crisis. These factors all contributed to the creation of the housing bubble. Now, this figure shows the leverage ratio for major investment banks in the United States from 2003 to 2007. We can see that all these 5 investment banks suffered deeply during the financial crisis, especially for Lehman Brothers, which went into bankrupt in 2008. The financial innovations included adjustable rate mortgage, ARM, asset-backed securities, ABS, collateralized debt obligations, CDO, credit default swaps, CDS, and so on. The usage of these products expanded dramatically in years leading up to the crisis. The adjustable rate mortgages were developed where there was a low teaser rate of interest that would last for 2 or 3 years and be followed by a rate that was liable to be much higher. This was a significant factor that caused the burst of housing bubble later. And now we are in 2006. The housing bubble is already extremely big. The national purchasing power had reached its limits, and the borrowers out of teaser rates could no longer afford the mortgage, so they chose to default. So suddenly, the supply went up and the demand went down. The price started to decrease in the second half of year 2006. What was the consequences? Let's say A guy borrowed $300,000 to buy a house, and the house price went down to $250,000. What does this mean to him? The amount of loan he owned is more than the value of his house, meaning that he has a negative equity. So there is no doubt that he would choose to default. And this is exactly what happened. More defaults meant more foreclosures. More foreclosures led to more supply in the market. And with the supply going up, the price went down even further. This was a vicious cycle, and eventually the housing bubble burst. From the previous example, it's not hard to tell that the non-resources mortgage has its own problem. It contains a free American-style put option. The borrower can sell the house for the higher value between the value of the house or the amount of the loan. The wrong pricing of the mortgage was another important reason for the burst of housing bubble. During the time when the house price decreased dramatically, some people had to give up their houses because they were unable to pay the mortgages. But there were also some speculators. They held rental properties and exercised the put option we talked about before when price decreased. More details. If there were two house owners, each of them had a mortgage of $20,000 to $250,000, and their houses valued $200. But if the houses went into foreclosure, it would be sold for $170,000. What would they do? They default and made another mortgage to buy the other's house. This actually happened because the houses in foreclosure usually surrounded each other. In normal market conditions, a lender can accept a recovery of 75% of the amount owned in the foreclosure. Statistics show that during 2008 to 2009, recovery rates as low as 25% were experienced in some areas. Following the burst of housing bubble, the high default rate ignited the bursting of the subprime bubble. Because the mortgage lenders had relaxed their underwriting practices too far and taken too much risk, they were extremely vulnerable to the collapse of the housing bubble. At the same time, the high delinquency rates led to a rapid devaluation of financial instruments. As the value of this asset plummeted, the market for these securities evaporated, and banks which were heavily invested in these assets began to increase a liquidity crisis. And this was the beginning of the 2008 financial crisis, a severe worldwide economic crisis. In conclusion, relaxed subprime lending, easy credit conditions, incorrect pricing of risk, predatory lending, deregulation, increased debt burden, and over-leveraging, financial innovation and complexity, weak and fraudulent underwriting practices. All these factors contributed to the creation and the bursting of the housing bubble and subprime bubble, which led to the financial crisis of 2007 to 2008. Our group number includes Chu Rui Li, Rui Qisha, Shu Yue Deng, and Shao Wenchang. Thank you for watching.